Well, good morning and thank you for joining the Ellerston Global and Morphic Funds webinar. My name is Lisa Rose and I'm the Head of Intermediary Sales at Ellerston Capital. Today we're joined by Bill Pridham, who's the Portfolio Manager for Ellerston and Morphic's Global Equity Strategies. In today's presentation, Bill will detail macroeconomic factors influencing portfolio positioning, provide an overview of the US stimulus package and its impact on key holdings, and give an update on fund positioning and performance for March. I'm sure many of you will have questions for Bill and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Bill to start the presentation.
So what we're going to talk about today is a number of points. We're going to talk through a fair bit of macro today, given how things have been changing globally and especially in the U.S. with the stimulus packages. So we're going to talk about some macro positioning considerations. I'm going to talk a little bit more about the U.S. stimulus packages that have come through and how we're positioned for that. And we'll talk about performance, and then we'll finish off with some Q&A at the end. So with that, let's hop right into it, if you don't mind. So firstly, with COVID and the subsequent policy responses we've seen globally, both fiscal and monetary, the economic and market cycles have really condensed and become accelerated over the last year or so. Positioning and stock selection, I think, has never been more important in this environment. And also, what I want to do is highlight, how we are looking at the setup today in the markets. And I'll talk through some of the positives in terms of fiscal stimulus, the monetary policy, the vaccine rollout and what's happening there, and a bit more on the reopening momentum, but also talk a bit about the risks we're seeing as well, just to get a more balanced view. So clearly inflation's picking up. We have supply chain bottlenecks out there. When you move from an early cycle market to mid-cycle, you tend to have multiple compression. We'll talk about that a little bit. We're going to have to pay for all this as well, so we're going to have some payback conversations here, and more longer-term potentials for policy missteps and taper tantrums as well. So that's more of a longer-term risk that we see on the horizon. So firstly, if we move to the fiscal stimulus. So when you think about it, governments remain hyper-focused on the deflationary aspects post the pandemic and as a result of the pandemic. The U.S. has been especially aggressive in this sense. And in March, you had President Biden announce the American Rescue Plan, which was another $1.9 trillion package aimed at more consumption and small businesses. And on the last day of March, he announced the American Jobs Plan, which was an additional $2.25 trillion of fiscal spending. And that's actually phase one. There's likely to be more, but I think he's going to phase them through to get easier passage through Congress. It's interesting when you think about all this, we've had a lot of fiscal stimulus, and we've gone through probably one of the worst pandemics and global drawdowns economically and through the markets we've seen in our lifetime. And Wells Fargo on their call last week said consumer net worth was up 10% in 2020. Incredible when you think about it. Consumer net worth was up 10% in 2020 in one of the worst pandemics and economic drawdowns we've seen in our investing career. Consumer net worth has hit an all-time high of $130 trillion. Clearly, the housing market's been strong over there. You've had a lot of pent-up savings as well. And when you look at it now with the final stage come through in this previous package, you roughly have around $2.2 trillion of excess savings in the market today. Personal savings rates have gone up dramatically, which makes sense. They're getting all these transfer payments, yet they can't go out and spend. So there's a massive amount of pent-up demand in the system right now. And then we shift to the monetary policy. Central banks continue to expand their balance sheets. If you look at the chart at the top right-hand side there, it's been monumental in terms of balance sheet expansion this year. And if you remember from past webinars like this, the spending this period has been more than QE1, QE2, and QE3 combined through the GFC. Been a massive amount of liquidity pumped into the system. Interestingly, you'll see that the ECB, Europe, has been more aggressive of late. And I think that's a function of the vaccine rollout hasn't been as fast as what it has been in the US. and economic growth is still pretty lackluster over there. So they're really expanding their balance sheet to try to catch up. Now, the thing is here, the Fed is targeting an average of 2% inflation. It used to be an absolute number, but now Powell's talking about an average number. What this means is that they'll tend to overshoot for a period of time. Interestingly, they have undershot their inflation target 11 out of the past 12 years. So he's of a firm view that you need to overshoot to get that level up. And when you think about it, we're just below 2% now, so the odds are you're going to be in the mid to high twos is where they want to run it. So you can see that they want to run the economy hotter than they have in the past. Now, in this last FOMC statement, they were quite clear that the job's not done. So there's still a lot of inequalities in the markets right now, mainly at the bottom end of consumers, and they have a firm view of their mandate. Their job is to target a certain level of inflation, which is that average 2% plus, and full employment. He views there's over 9 million jobs that are still lost, and he wants to get them back. So I can't see them looking to change their strategy anytime soon. And that's one of the underpinnings of this market right now is that liquidity and their intention to maintain that liquidity as well. When you look at the bottom chart, though, money velocity, it's at record lows. And that's what is kind of curtailing inflation to some degrees at the moment. And it makes sense when you think about it. You've had a lot of money pumped into the system, both fiscal and through the monetary policy, yet nobody's been able to spend it. So consumers have been in lockdown. So they've been saving these excess deposits coming in. And over the pandemic period, we saw a lot of companies just pull back their spend. So there was very little CapEx done. So that makes perfect sense that money velocity is at these levels. Odds are that it'll start to pick up as economies reopen and as companies start to spend on CapEx. And we're already seeing the companies start to announce their intentions of really ramping back up to previous levels and actually trying to catch up from underspending of last year. So we'll probably see that start to pick up over the next several quarters. And just touching on the vaccine rollout. So look, it's been, fits and starts when you think about it in terms of the rollout itself. When you think of, Canada, U.S. is still picking up in cases, Europe is still picking up in cases, but they're really focused on getting that vaccine in the market, creating some level of herd immunity. That does take some time, and it's just about getting the populace vaccinated at the end of the day. So there's a number of companies that are well advanced. We can see Israel, UK, US well advanced in terms of the rollouts. Yet there's a lot of companies that are well behind, and mainly when you think about it, there are a lot of emerging market economies that are behind. They haven't had the access to the vaccine the way the DM markets have had. And that's a little bit of a risk in my mind longer term in terms of getting to that global herd immunity because you need them to have the vaccine as well. President Biden is incredibly aggressive in terms of getting the U.S. populace vaccinated. He wants to have them all at least with one shot by May the 1st. So that's an incredibly big ask, but he is putting plans in place and infrastructure in place to make that happen. And if you look at the bottom chart there in terms of number of doses, they're ramping up dramatically as well. So he's putting the infrastructure in place to make it happen, and now the doses are coming in to enable it as well. So, it may skip a month or two, I don't know, but there is a strong impetus to get the vaccines done and rolled out. Interestingly, Europe has been well behind on this. They've been, 1 to 2 months behind or a quarter potentially in terms of what's been going on in the U.S. From what we understand, Moderna is really ramping up distribution into Europe. So hopefully we'll see the European vaccinations really start to pick up, and that'll create a level of confidence over there as well. Just a bit of an anecdote. So we had a call with one of our portfolio companies, PTC. This is a month and a half ago. And his wife had got the Pfizer shot. And he said as soon as she got that shot, she was bulletproof. Like she was out shopping, she was being active. So it just shows you how it can create confidence. And it's all about getting those vaccines out there and creating that confidence levels. The other uncertainty right now is the variants that we're seeing. Right now, there's quite a common view that the current vaccines will treat a lot of the variants. But what we do understand is the platforms are in place now that you can actually tweak these existing vaccines to address the new variants. So, look, we've had a lot of smart people, a lot of smart technology aimed at this. And it's still a battle at the end of the day, but they're making very good progress. And the governments and the economies need this to happen, and they're being very proactive in terms of making this happen as well. Now the reopening momentum. It's we've seen an incredibly sharp snapback in economies. And clearly, it's a function of the fiscal and monetary spend that we've seen, wartime levels of stimulus in the markets today. And it's interesting, Wells Fargo, in their call, they expect this year GDP to grow faster than any year since 1984. And that's that V you can see in the top right-hand chart there. It is snapping back a lot faster than what we may have thought a few months ago. Clearly, that is creating a lot of its own momentum, in terms of as the economies are snapping back, that creates demand for other economies that are supplying them. So kind of a self-fulfilling prophecy there. The thing is, it's incredible. I think you've heard me talk about it, with the pandemic. We went from a late stage economic cycle in January, February last year to an early stage cycle in a couple of months. Now, with all the fiscal and monetary stimulus, we're back to a mid-stage cycle again in a few months. And that's my point at the beginning. Economies and markets are moving at an accelerated rate with what's been going on here. And, clearly that likely doesn't change anytime soon. But right now we have to address that and understand what that means from an investing point of view. There's a lot of talk about manufacturers, supply chains trying to catch up, and they can't. When you have economies or markets shut down for a couple months, it takes time to ramp it back up in terms of supply chain, because this manufacturer may be dependent on the previous one who's waiting on another one, and it's just a domino effect, and it takes time to ramp that back up. The trouble is they're trying to catch up, and in an environment where demand is just accelerating on itself. So we have private and public pent-up demand. And what I mean by that private pent-up demand is the consumers, excess savings, especially in the U.S. You think about that 2.2 trillion of excess savings, and public pent-up demand. You got all this fiscal stimulus that's still to feed through the system. And when you think of government stimulus, it takes time. The recent package, it's an 8-year period. So that will feed through the markets over time. It's not a 1 month or 1 quarter type of event. It's a very long-term opportunity from a demand point of view. And you can see the PMI, highest since 1983. We could throw so many charts in here to show you what's happening in terms of the snapback, but it's very real. And now a lot of the markets commentators are expecting economies to return to pre-pandemic levels by the end of this year, early next year, which is an incredible 180 from several months ago. So with all that, it's always good to talk about the positives, but, let's talk about some of the risks that we see, some of the things that we're watching very closely in this environment. Raw material costs are picking up pretty dramatically. We're hearing so many stories of how much chemicals, lumber, steel, freight costs are going up. We have supply chain bottlenecks. As I mentioned earlier, you shut down a number of supply chains. It takes a while for them to catch up, especially the semiconductors. It takes time to ramp those foundries back up, to get them certified, to get them tested. And that takes several months at the end of the day. And we're hearing a lot of stories around, especially in auto, of semiconductor chips, the lack of supply there. And that's creating a lack of supply of autos for insatiable demand that's out there right now. So if you're a glass half full person, you can say that will elongate the cycle. Near term, there's a risk around that in terms of companies saying, well, you know what, we couldn't get the supply, so we couldn't sell. But you know what, I think the market will tend to look through that, similar to how they looked through the pandemic issue we had several months ago. One company that is really quite a poster child for this is Fastenal. So they're listed in the U.S. They reported the numbers last week as well. And they basically sell nuts and bolts to basically every industry and manufacturer out there. Everything from combines and John Deere down to steel rivets in a building. So they're in every aspect of the industrial market. And in their past call, they're saying that we're seeing significant material cost inflation. Steel, fuel, transportation costs. And now, from Q1, they're going to start instituting their price increases. Now, you may say, well, why are they starting those price increases now and they didn't before? The reason is because they were using all the previous inventory, which were at lower cost. So now you're having those higher cost of goods sold feed through their P&L, and they need to put price rises through. And that's my point around the inflation side of things. So it's going to be another quarter or two before you see the real impact of inflation in terms of the real numbers coming through. Because now we're hearing and seeing a lot of companies say, okay, we were able to hold our margins based on our past cost of goods sold. Now we're buying at much higher spot rates, and we're going to have to start putting price rises through. So I think that's going to be a common theme you'll see over the next couple of quarters. The concern around that is, when does the market really start to reflect that in terms of valuations? Right now, the market thinks it's transitory, which means that supply chains will catch up, raw material prices will level out, and then we'll cycle all this next year, and you won't have that continued inflation feeding through the system. I'm not too sure what happens there. I've got very little edge, but my concern is once we start seeing these higher prints, does the market get a bit concerned around that from an inflationary point of view? But like I mentioned, the federal government, the markets right now don't seem too concerned about it, but it is something we're watching quite actively, especially as supply chain bottlenecks continue to build on themselves as well. Now, multiple compression. So this is more of a discussion around the overall market and pressure on multiples. So when you go from an early stage market, from a late stage market to early stage, you get a lot of multiple growth coming through because the market is paying for more growth. Like I mentioned, we're going from early cycle to mid cycle very quickly. So when you think about it, we're probably going to cycle the biggest growth period or peak growth numbers in the second quarter. That's when the peak pandemic was in. So, that March to June period where a lot of the economies globally were shut down. So we're going to see some incredibly big growth numbers in a number of industries on the back of that. But then following that, you're going to be cycling some strong improvement numbers. So that means that your absolute growth rate number probably comes down a touch. You're still going to grow, but it's not going to be those big growth rate numbers we've seen over the last few quarters. And what typically happens through that type of period is you get multiple compression because the market was being priced for this level of growth where it's going to be a bit lower now. So you have a bit of multiple compression. So I think we'll see that over the next couple quarters as well. And when you think about it, we're already seeing it in those at-home winners, like a Zoom. So Zoom was the poster child of at-home winners. The stock went ballistic through this whole period. But in October, it peaked. And it's interesting why October. Well, in November the 9th, Pfizer announced that their vaccine was deemed 95% efficacy. And that created this shift from at-home winners into more your reopening plays and more cyclicals financials. And it's interesting, since October, Zoom is down over 40%. So they're still growing at an incredibly fast clip, yet their multiple has been compressed. So I think we'll see that across a number of those industries. The offsetting factor here will be if you're in companies that are growing faster than that multiple compression, companies that are still reopening winners, not your at-home winners per se. And those ones are showing some real strong operating leverage. So you could see earnings growth more than offset that multiple compression. That's what we're targeting our investments at as well. Now, payback. So clearly, there's multi-trillion-dollar spending going on globally. And it comes at a cost. Like, it's got to be paid back at the end of the day. There's reports that Biden's initial tax package is around $3 trillion to help pay for the American Rescue Plan and the Americans Jobs Act as well. So clearly, this all comes at a cost at the end of the day. And when you look at this cost, it could be in the form of corporate tax. They're already saying we want to propose a 28% corporate tax. Very unlikely it gets there, but we could probably see, mid-20s type of thing, up from 20%, 21% today. We'll probably see global multinational taxes come in. We could see individual tax increases back to the pre-2017 levels. We could see financial transaction taxes come in. There's one word in there that's common: tax. So that's the way they're going to pay for a lot of this, is through increased taxes coming through. Right now, the market's not concerned. And I think the reason why is that the scope is still unknown. Republicans in the U.S. will be pushing back against this pretty aggressively. They do not want to have a lot of tax increases or rollbacks of what they put in place through the Trump administration. So they're looking to push back on this. So there's a big unknown. But at the end of the day, you got to expect some level of tax increases to come through, and take that into account in terms of the valuations and your earnings profile of the businesses you're looking at. And you put all that together, the market today is certainly not at a trough multiple. They're at record highs globally. So you're not being compensated by a very cheap multiple with this increased tax levels, the inflation, supply chain as well. So that's something we're very considered about as well in terms of the valuations from an overall market point of view, and why it's incredibly important to look at stock specific. The market can flatline from here, but underneath the hood, you can have some real asset rotations where you can make some really strong returns from. And that's what we look at. And that's why I think from here on and over the last year or so, it's been so much more important to have an active strategy rather than passive, because the market is shifting and you got to be on top of these shifts or else you can be left behind quite materially. The final one I want to talk through, and this is real longer term, it's policy missteps, taper tantrums. The biggest taper tantrum we saw was back in 2013 when Ben Bernanke said he was going to start pulling back on the QE, and the markets had an initial drop on the back of that. So it's all about that communication. Right now, the FOMC is talking about nothing this year. We're not even thinking about it. But I think if you'll start to see them start to convey it, maybe June, September timeframe, then we're starting to think about this. Depends on the economies and where inflation is at the time as well. But when you think about it, central bank balance sheets are incredibly expanded over the last several years. Right now, it's not too big of a concern because interest rates are so low. And it's funny, even though the balance sheets have expanded so much, their costs to service that have gone probably flat to down because rates have come down so much. That's okay now, but it's also a risk if rates start to pick up. And when you think about it, the U.S. especially has added trillions of dollars to their balance sheet. This chart doesn't even include the December or the recent stimulus announcements around what's happening there as well. So the big questions are, how does the Federal Reserve respond to rising rates, the cyclical recovery, rising inflation expectations? Are they transitory? I know I'm giving you more questions than answers here, but it's stuff that we're watching pretty aggressively. And the biggest risk that you have with all this are bond vigilantes. So they will tend to front run the Fed. If they see inflation really picking up, they will push those inflation rates up and potentially force the Fed's hand, but not before the markets start to correct. This is a chart of 1987. Look, the setup is so different now to back then, but it just shows you how a dramatic rise in rates can create a lot of market uncertainty. Remembering that was just an extraordinary period. But I just wanted to highlight that's a risk we're watching, a risk we're cognizant of, but not a risk that we're concerned of just yet. So I want to take a couple minutes just to flesh out the U.S. stimulus packages a little bit more and talk about how we're positioned for it, because I think that's incredibly important, how you're positioned for this. The spending, President Biden saying this is the biggest domestic spend since World War II. So with that, you want to be participating in that somehow. I believe he has said what he wants to do. He has the people around him to make it happen. And the only impediment will be Republican pushback. But given he has such strong power now in both the House and the Senate, I think he's got a good opportunity here to get a lot of the stuff he wants done. So firstly, we'll talk about the American Rescue Plan. So that's the third focus on the consumer small businesses in the U.S. This one's in the $1.9 trillion. If you remember, I was thinking it'd probably be more the 1.5-ish, but he got the whole thing in and through. Interestingly, every individual over there that makes less than $150,000 will get a $1,400 check or deposit in their bank account. And it's actually not about that $1,400. It's about when you add the child tax credit, when you add in a number of the other incentives that they put in place. It actually adds up to around $14,000 per family of four in support payments over the past year. It's incredible when you think about it, $14,000 of support payments. And the thing is, much of that support hasn't been able to be spent because they've been in lockdown, because a lot of the supply has been shut down. Well, now it's starting to open up. So you can see a lot of that spend now starting to be deployed over the next several months, and we're overweight discretionary on the back of that. So we have companies like PVH who own Tommy Hilfiger, and they own Calvin Klein as well. So on the apparel, on the reopening side of things, we own a position in Yeti, which is about outdoor coolers, coffee mugs, you name it. We own Tempur Sealy, which we've talked about a lot in the past. So, bedding, believe it or not, you would think that's an at-home winner, but actually this year it's still an absolute winner in terms of spend. The housing market, housing formation is going up. You need to put beds in there. And this year they're expecting revenues to grow 15 to 20% after growing even more last year. So very strong opportunity there. We have a group of set, which is cookware, domestic appliances, Bed Bath & Beyond, which is one of the larger owners of childcare accessories and apparel in the U.S. with their Bye Bye Baby business. And also they sell a lot of consumption items for the consumer as well. A lot of the banks will benefit from this because, the consumer loans will get de-risked pretty dramatically. We just started the reporting season in the U.S. and the banks are writing back a lot of those provisions that took in place about 12 months ago. So they're reporting some very strong numbers coming through. We also have AZEC, which is outdoor decking as well. Again, housing formation, housing growth, more money in my pocket. I want to really improve my home. So there's a number of ways we're playing this consumption trend in the portfolio. Now if we move to the American Jobs Plan, which was announced at the end of March. This is just phase one, like I mentioned, a little over $2 trillion. There are thoughts that the next phase will take it up to around $4 trillion. Don't know. But we'll see what happens here. I think this one's very focused on infrastructure, but it's not the old infrastructure as much. No, I shouldn't say as much, but it's more than that. So you think of the roads, bridges, and ports. Yeah, he wants to spend a lot on that. But his catch cry is that he wants to build infrastructure that's necessary to build the economy of the future. And what does that mean? It means 5G spending. It means broadband access for all. It means semiconductor capacity in the U.S. And more importantly, overlaying all of this, he really wants to ramp up R&D. So, we haven't heard a lot of discussion around the U.S.-China trade disputes. That's still in the background. I don't expect any rollbacks on that. But I think the U.S. is incredibly focused on making sure that they are, accelerating ahead of China. China wants to be self-sufficient in a lot of these areas. I think the U.S. has finally realized that they need to spend a lot more to not just keep up, but they want to get ahead. And that's why they're really focused on, the next generation technology. President Biden's all about American jobs. He's all about American manufacturing. So you're seeing a lot of the spend reflected around this. And as you're probably well aware, he's all about clean energy. And that is a function of the next generation opportunity. Electric vehicles, the charging stations, the clean grid, effective with wind and solar as well. So there's a number of different angles here that they're looking at. But if you take one thing away from all this, it's all about sourcing domestically. And he wants to do this in a real strong domestic jobs growth environment at the end of the day. If you remember earlier, I talked about Jay Powell was saying we're still 9 million jobs under right now. President Biden understands this, and that's what this package is really focused on. So how do we play in this? So we have WillScot, which we've owned for years. So WillScot has, 45% of the modular office market in the U.S. So you drive by a construction site and you see those temporary office buildings on there. That's what WillScot does in the U.S. and they have 45% market share. So they're really Delta One to all that. We have Keysight and Enritsu. They're on 5G testing, Keysight especially on electric vehicle testing, on battery testing. There's really 3 players in the world that do that at scale. We own 2 of them. The third one's private, German company. We own Keon Group, which is forklift trucks, supply chain management, making supply chain smart. So that's what they're big in. PTC, which we had a deep dive in last month. They're all about smart manufacturing. They're all about creating the next generation of connectivity for factories and making them more efficient. And clearly the banks are going to benefit from all this as well. Increased economic activity will help them, will give them somewhere to deploy all those deposits that they have on their books. They're incredibly deposit rich, but they haven't been able to get the loan growth. So hopefully now you'll be able to start to see those loans start to pick up. Bureau Veritas there as well. So when you think of the electric vehicle charging stations, you think of all the infrastructure that needs to be built. It needs to be tested, inspected, and certified. Bureau Veritas is a leader in that space. And they are looking to really augment their vehicle charging inspection. You don't want to get a jolt when you're plugging your car in. President Biden's plan is to build, I guess, like 500,000 charging stations in the U.S. over the next several years. They all need to be tested, inspected, and certified. And Bureau Veritas is a key player in all that. And I should have talked about XPO Logistics in the last slide as well in terms of the consumer. When you think of e-commerce, when you think of the retail growth that we're going to see, it all needs to be delivered. When you think of the industrial markets here, it all needs to be delivered. And XPO is one of the larger LTL trucking companies in the U.S., and they're one of the larger contract logistics players globally as well. They're spinning off the logistics business, which will provide a strong catalyst, I think, over the next few months for that one. So I just wanted to highlight a little bit more on the U.S. stimulus, both the rescue plan in terms of what that does. The rescue plan, I should have pointed this out, it really looks after the bottom part of the K. So when in this recovery, has businesses and people really benefiting from it, but you've had a lot of people and businesses really get dramatically impacted by it. So President Biden's really looking at that bottom part and looking after that bottom part of the K, putting a social net in place. And I think that's a big difference from what we've seen historically. So with the rescue plan and the jobs plan, I think I want to just give you an overview of how we're seeing it, but more importantly, how we're positioned for it. You know, the majority of our fund should benefit from this from a first order, not from second derivatives, but they're participating in this today. And we view that as a strong longer-term opportunity for them as well. So with that, we'll talk a little bit about performance. So it's actually quite special. The end of March was the 4th year of the Ellerston Global Mid Small Cap Fund, so it's our 4-year anniversary. Since that time, we've been doing quite well. So since inception, we've compounded just under 17.4%, which compares well to the market. And if we look cumulatively, we're a little over 92% versus the market a little over 59%. So we're quite happy with that. But remembering over these 4 years, we had the global pandemic where the S&P dropped over 34% peak to trough. We had, remember in October to December 2018, that was a real tough period as well. The markets were down 20%. And we had 2 other drawdowns of close to 10% as well. So we've had some pretty serious drawdowns over the 4 years as well. Now, my takeaway from that is we look to invest with high conviction in high quality businesses that operate in secular growing industries and ones that we feel have a price discovery opportunity inside them. So that philosophy hasn't changed. It will not change. And I think it's proving out in the numbers that it's driving a great risk return opportunity for us all as investors in the funds. And I think it is really demonstrated by the upside downside capture as well. If you look at since inception, we've captured over 110% of the upside, whilst only being impacted by 78% of down markets. So with that spread, if you can keep that spread over a long period of time, you're going to make money at the end of the day. And for us all as investors, if we can keep that spread in place, we should do quite well over the long term. And I hope one of the takeaways from this is that we're very cognizant of what's going from the macro perspective, but we're very focused on the micro of the companies that we own and making sure that our companies are participating in some of those big macro drivers, which seem to be changing every 3 months. It takes a lot to keep up with, but we're trying to keep on that front foot and making sure we're positioned properly from that. Just a quick call out to the Morphic Global Opportunities Fund. The big takeaway as a fund itself, if you remember, I took over the funds in October. They're all mirrors of each other. So when I talk about the Ellerston Global Fund, I'm talking about the Morphic Global Fund, and I'm talking about the Morphic Ethical Fund, which I'll touch on in a second. They're all mirrors They all have the same investments. I'm running them as the same fund, effectively. So just take away from this is when I talk about one fund, they're all the same thing at the end of the day. And just talking on the Morphic Ethical Equities Fund, MEC is the code. So listed on the market, so it's a listed investment company. The other two funds are trusts. So this is the only listed vehicle that we have. But what we have been doing the last few months is highlighting the dividend profit reserve, which at the end of March was 27.1 cents. Compare that to our latest published NTA was $1.42. Compare that to our last price yesterday was $1.12. So you think of $1.12, $1.42 of net asset value in there with all those companies we've talked about, with 27 cents of profit reserves in place as well. So very attractive vehicle in my mind as well. So with that, I wanted to touch on Q&A, Lisa, so I'll hand it back to you.
Thank you, Bill. A couple of questions have come through already, so any participants wishing to ask a question of Bill, please submit them now. Bill, the first question for you is your cash holdings seem to remain low. Are you worried at all that the market is reaching frothy levels?
If you remember, that's a good question. So the market can do, I can't really call where the market goes, but what I do try to call is where my businesses are going and the risk reward within those businesses. If you want to take away from this whole presentation is you need to be quite nimble from an asset allocation point of view. If you remember in September, we shifted pretty dramatically into cyclicals, financials, industrials, which worked well as the market has pivoted there as well. So like I mentioned, the market is, it's not at trough multiples today. A lot of them are at record highs, so that is a definite concern. I will say over the last couple of weeks, we've been harvesting a bit. So as the share prices have been going up and our risk reward becomes less and less attractive on some of the names, we've been trimming them back. Not completely exiting, but just trimming some substantial overweights that we had, trimming them back a little bit. So right now, in terms of cash balance is probably, let's take a step back. So cash balance looks a bit lower than what the actual net exposure is because I do have an instrument in there which is kind of a short market, but it's a long instrument. So it adds to the exposure, but actually detracts from net exposure. So if you think of net exposure, Lisa, probably in the 88.5, 89 level. If market continues to be strong, that'll come down. If I see more opportunities, that'll go up. So I'm not in the business of, and I wouldn't add any value trying to call where the market's going. I always find the positions will drive my level of investment. And right now, I'm still seeing some pretty good opportunities in them. And if I change my mind, that positioning will change. But right now, I'm pretty comfortable.
Thanks, Bill. Next question for you. In the event of a significant market drawdown, how will mid-small caps fare versus their large cap peers?
Yeah, it's an interesting one. Historically, when you think about that, mid-smalls will underperform large caps in a significant market drawdown. It's a function of liquidity, but it depends on what's driving that drawdown. So if I'm thinking that inflation is going to pick up and I'm thinking that the market's going to get concerned with inflation expectations and momentum stocks, high PE stocks tend to underperform in that environment. Long duration assets typically underperform in that environment. Typically that inflation increase will be driven because of, right now at least it's being driven because of increased economic activity. Mid-smalls are more exposed to that mid-small, are exposed to that domestic and international activity levels. So it's a tough one. It's very hard to call. My gut feel is that initially you'll see, if it's an inflation scare, you'll see the big cap momentum, high PE, long duration assets underperform. You'll see the mid-small cap market outperform. And we've seen that since November last year. Rates have gone from 60 bips to 160, and it's been those mid-smalls that have dramatically outperformed over that period of time. So it's a tough one to answer, but I will say it just depends on what drives it at the end of the day. Longer term period around that, you could see flight to safety. And I think what you're taking away from this, I have no idea. But what I do know is that the businesses that we own will perform relatively well in that environment.
Thanks, Bill. We don't have any further questions that have come through. What I might do is just pass back to you for a final comment, and if any questions do come up, I'll jump in at the end before we close.
Great, thanks for that, Lisa. So I guess the one thing I wanted to, or one takeaway is, or a couple takeaways. Firstly, thanks for the feedback from the previous webinar when I did a deep dive on one of our companies. We had both positive and negative commentary on that, so I'll take that on board and look to incorporate that going forward, maybe not as deep or maybe a bit more broad. We'll see how it goes. The other takeaway is I'm typically not that intensely focused on the macro environment, but I think as the markets have been gyrating so much, you need to be very cognizant of what's happening from a positioning point of view. When you ask me where the market's going to go in the next month, 6 months, I really don't know. But what I do know is that the businesses that we're focused on, the business that we're all invested in, that I'm invested in, I feel have the best opportunity to perform in many different scenarios out there. Still maintaining quite a balanced portfolio. So we do have businesses that are more in the value space. We have businesses that are more in the growth space. So I want to be out there participating in many different scenarios. And I think you've heard me talk about that before, and I think it's showing up in the numbers. No matter what environment is out there, we should, or hopefully should, participate in a positive capital way in the medium to long term.
Well, thank you, Bill. We haven't had any further questions come through, so we might leave this session there for today. So to all our participants, thank you for attending, and I trust you found today's session with Bill useful. A recording will be sent through to all participants shortly, and we've also secured the date for our next Global Equity webinar, which will take place on Tuesday, the 18th of May at 10 a.m. You can register to attend through the News and Insights section on our website, ellerstoncapital.com. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you all again for attending, and I trust you have a good rest of your day.
Great, thanks so much.